Okay, so here's the deal. Mortgage rates in Ontario, yep, they're climbing again. And honestly, they're moving faster than your property tax bills, which is saying something these days. In just last 3 weeks alone, we have seen the average 5-year fixed mortgage rates in Ontario jump from what was relatively comfy, let's call it just under 4%, to now sitting right around 4.6, and the variable rate 4.67. So basically fixed or variable. Either way, you are paying more today than you were just a few weeks ago. That half a percent bump, that's not just a number on paper, it's real. It hits your monthly payment, it hits your budget, and it's already starting to choke out affordability, especially for first-time home buyers or anyone sitting on thin margins. This isn't just a rate update, it's a financial gut punch for a lot of Ontario households. Now, let's rewind just a bit. Go back to May or maybe early June this year. It honestly wasn't that long ago. If you were shopping hard, and I mean hunting, comparing, and maybe working with a mortgage broker who actually knows what they're doing, you could have logged in a 5-year rate at somewhere around 3.79. Seriously, 3.85, totally doable. Maybe 3.89 if your credit were just decent and you were looking to refinance something overly complex. Today, that same borrower is staring down at 4.6, maybe 4.7. Some lenders are even pricing in 4.75 if the file is remotely tricky. And yeah, you don't need me to tell you what that means, but I will. It means your qualifying rate, the stress test hurdle, just went up. It means your monthly payment is now higher. It means more of your paycheck is going to the bank and less is going to, life. And if you're stretching to qualify already, that extra half a point might mean the difference between buying now or sitting out till 2026. Now, let's talk actual numbers because we don't do vibes here. The average resale home price in Ontario this June, about 804K. That's 6.9% drop year over year. GTA is still hanging around 1.12 million, which sounds high because it is, but even that's down about 3.8% from last summer. And that's when we zoom into cities like Mississauga, Brampton, we are seeing roughly 5% year over year decline. Real prices, real dollar, real impact. This isn't just a little cooling on the margins. This is structural. Sure, there was a small bump in activity since April this year. GTA sales are up about 17%, but let's not kid ourselves. That's still 14% below the 5-year average. So yeah, there's some movement, but we are nowhere close to a hot market. So what's actually driving this mortgage rate spike? Well, let's break it down. First, mortgage yields, those have been climbing. That's directly tied to fixed rate mortgage pricing. And why are yields up? A couple reasons. Inflation is still sticky, still hovering above 3%. The June jobs report came in harder than expected. Canada added over 83,000 jobs and unemployment held at 6.9%. That means the Bank of Canada isn't moving. They held the overnight rate again this month at 2.75%, and all the signs says they are likely to hold it until at least September this year before we even talk about a rate cut. Now combine that with ongoing tariff drama, global trade uncertainty, and fact that bond rates are allergic to good news. They're pricing in more risk and lenders are passing that straight to you. And look, when the rates go up, real estate cools down. No rocket science. But here's the nuance. If you're listing a perfect home in a perfect neighborhood with a perfect school district, those homes, they're still getting action. Maybe not with 10 offers like 2021, but they sell. But the average homes, second tier semis, the cookie cutter townhouse in Brampton, Pickering, or Ajax. Yeah, those listings are sitting and prices are slipping, especially anything tied to student housing, places that used to pack in 6 tenants and now they're selling half empty. Even Niagara is feeling the heat. Power sale listings are creeping up. Those new comps, they're dragging down the neighborhood benchmarks. And Windsor, honestly bleak. The big auto plan restart still a giant question mark, and local real estate reacting accordingly. So what does all this means for you? It means the Ontario housing market is officially leaning towards buyer territory. Mississauga's sales to new listing ratio around 25%, GTA overall sitting near 29%. Hamilton, a little more active, closer to 39%, but still below anything we would call hot. If you're a buyer with a decent down payment or you're renewing this year, you have a leverage, but only if you know how to use it. If you're relying on Bank of Canada to save your budget with a summer rate cut, might want to rethink that. So here's my advice. If you're renewing, refinance, or thinking of buying in next 6 months, do not wait around hoping the rates will magically drop. They might, but they might not. And the cost of waiting could outweigh the gains. Let's talk real strategy. We'll look at your current rate, your break penalties if you are renewing midterm, your new qualification threshold, and whether fixed or variable actually makes sense for your situation, not what headline says. This isn't about hype, this is about running the maths. So if you're in Ontario and you want clear, honest mortgage advice with real numbers, reach out. No fluff, no pressure, just straight up strategy that works for real homeowners. Don't wait, reach us out today. info@ajpmortgage.com or check out our website ajpmortgage.com. Call us at 844-354-3033.